Hello, everybody, and welcome to our first session of the year. My pleasure to be here with you today. Let me turn on our disclaimer on the bottom part of the screen as we are getting started, as always. And again, today the session, which is the first session of the year, is a session where we're gonna discuss what May 2024 brings in for us when it comes to traders, investors, opportunities, risks, what to expect, how to deal with various situations. And we will be going over multiple markets, such as equities and futures and equities, as well as options, and all of this in the realm, as I was saying, equity markets or indices, also specific stocks. We'll look at currencies, we'll look at metals such as gold, we'll look at energy products such as oil, etc., etc. And also, I welcome you to type in the chat box any symbol you would like me to analyze for you. Happy to do that. And talking about the chat box, as we are getting ready to get started today, it would be great if you could just type a quick message, just so I know you are here. I know that sound is good, video is good, all is good, and you're ready to work with me. Mark, how are you? Good to see you, Mark. It's good to again to see everyone connecting to the session live. And if you're watching this recorded, of course, it's also very good to have you with us. So let's get started in this first session of the year. And we're going to start one market at a time. Again, feel free at any moment in time to go ahead and type on the chat box. Maybe you want me to check, I don't know, McDonald's or anything else out there. Again, I'll be ready and happy to do that for you. Okay, but I'll start with the big ones. I'll start with the classical markets, which are the most relevant markets, the most impactful markets out there in the world. And as you can see on the screen, I already have one loaded here, which is the S&P 500, which we're going to be looking and analyzing from various angles. The first angle is going to be S&P futures. We'll also be looking at SPY ETF, which is another form of the same market, which is extremely relevant. Joe, it's very good to see you. Happy New Year. Jeff, is also very good to see you. Happy New Year. I see, Jeff, you are interested in looking at gold. Joe would like to take a look at Walmart. So for sure, we're going to do that. Okay, so maybe since I kind of already started with the S&P, I'll do that. And from there, we'll move into Walmart because it's equities. And then I plan to go over gold, Jeff. So then we'll take a look at your ticker symbol there. So S&P futures, what do we have? Well, you see me many times starting my analysis looking at a daily time frame. Of course, today we are doing a session which is a bit different because we are looking at what 2024 may provide. So I'm going to start analyzing the monthly time frame. Yes, you heard me well, monthly. It's a really relevant time frame. The challenge with this time frame is patience. So, for example, here, look at the beautiful buying opportunity that took place when the S&P dropped into this beautiful UFO. This is great, but let's say the market was trading there when you saw that UFO, you had to wait 1, 2, 3, 4, 5, 6, maybe a year and a half for you to get into the trade. Now, of course, if you did, then it pays extremely nicely. But it's a bit of a challenge, for new traders or for traders that want to be more active to also learn to be that patient. Okay, now beyond trading style, beyond the fact that maybe this is actually your bread and butter, maybe you are not an active trader, you're more a long-term trader, passive investor, that kind of thing. So putting that on the side, who are you as a trader or investor? Putting that on the side, this time frame is very relevant to analyze for everybody to understand what to expect in the long term. Because, you may be looking at time frames such as daily, where, you may see price come here closer to a UFO, or maybe you expect price to bounce from any of the UFOs and go back higher. But the question is, how far up? And yes, of course, we can have measurements thanks to our autoclimate, as we do often. We look at, what is the count, what is the max distance, okay? And this is definitely very powerful if you plan to be active in this particular time frame. But if you plan to use, let's say, daily entries to ride longer term trades, well, you may be okay with going through situations where, you have some blue followed by some red, then more blue, red, more blue, some red, more blue, some red, more blue, some red, more blue. And in the end, if you look at, what was the beginning of the story here on this improvised drawing of mine, well, the beginning of the story, end up you being ahead of this horizontal line. Why? Because if you were to go back in time and look at the monthly time frame, there was room for a potential movement to the upside, putting on the side that this significant drop in price is what brought the prices inside that monthly green UFO I mentioned before, right? So when price got here, again, there was a great potential for the market to keep going because of what the monthly time frame provided. So I'm just making these comments that to some of you may be obvious. If you are a trader who has traded for a while, within your trading style, depending on your school of thought and how you have been trained, you may do the classical top-down analysis, you may do the classical multi-time frame analysis, etc., etc. And therefore, what I'm saying probably resonates well with you. In this case, I'm just being a bit more pragmatic in the sense of, is there room for movement on a monthly time frame? That's all I'm looking for, really. Instead of doing this classical type of analysis, I'm more looking at, is there room for movement? Because if there is room for movement on a monthly time frame, then typically you will see on the daily time frame, you will see blues and reds, because markets need to impulse and then correct to then impulse again. But those collection of movements, impulse versus correction, will lead to movements that continue progressing in a direction for multiple months if there is room in the monthly time frame. So, long story here on the S&P, which I will keep short in the following markets, but I wanted to make my point of why am I starting with the monthly time frame. Juan, it's a pleasure to have you here. A very, very big smile on my face to see you here, Juan. Thank you for joining us. John, very nice to see you as well. We got Juan John without the H, and we got John with the H. So two Johns in the room. Welcome, my friends. Anyway, so we have this analysis of the S&P, okay, and obviously by looking at this market, we can see things that we have seen before. There was an all-time high. The market went a little above that, little tiny tees, and now it's going down. Well, if I was going to, just for fun, okay, I'm not acting as a technical analyst here, but just for fun, if we were to go back to 2007, and at that time you had the high of the market set in 2000 before the tech bubble crash, little tees there, and then you got the whole 2008. So if you were to observe the markets from this angle, you would probably say, wow, this is a scary thing, right? This is a very scary situation because we may have a huge collapse in the marketplace. And by the way, this could certainly happen. The economies are not too good in many places in the world. There are wars, all sorts of things going on. So this could certainly happen. But what we do have right now that we didn't have in 2007, 2008, that was October 07 to be precise. What we do have is we have a beautiful UFO here. So the expectation really will be for the market to come back down and from there continue. Okay, so I'm not saying I'm crazily bullish in the market, but definitely I'm not crazily concerned. That I will say. Okay, so anyway, let me go deeper into this conversation. So statistics in the monthly time frame, the climate is blue and confirmed with a count of 2, where a normal thing to happen is 11 on the way up. Okay, so in other words, should we expect a correction? Could be. If there is a correction, is it likely going to be a crazy impulse in the opposite direction? Or based on the climate, it's likely going to be just a correction. And as I said, price comes to this UFO and from there it keeps going. Well, I guess that you are with me. You understand that based on reading the outputs of our technologies, 2 out of 11 is a pretty healthy situation. It's definitely, we are in a confirmed climate. Statistically speaking, there is nothing to be concerned about, and definitely there are buy orders below price, okay? And that was not the case in 07, right? If I was to go back to 07, right, and I was to replay the markets all the way to, let's say here, when the market pierced. So the UFOs at the time were way lower, okay, way lower. The UFOs right now are way closer, okay? So the first wave of movement to the downside in 07 had so much more room for this market to go down. And if I was to show this, and again, while the history repeats itself, and we can talk about that, it's a very different situation. You can see how that UFO created an initial bounce, and the fact that the UFO was gone after some trading now opened the room for so much more fall with nothing to stop it, right? So if we go back to, and by the way, we also know that at the time we were in a down climate, which is not the case now. We are in an up climate, isn't it? So very different market condition compared to what was happening in '07. And again, I'm just showing you one case. This is statistically not relevant. Just to show you one case, it means nothing, right? So even though market gurus would spend 3 hours talking about some candlestick formation sometime in the past that they only see once, and it's like irrelevant. Well, statistically speaking, you need a large collection of samples to have some relevance, right? So that's only one. But I'm just saying because you will probably hear a lot of talk out there in places that this is something that may concerns you. Well, just know that while anything could happen anytime and we may have a huge collapse, the fact is that we are in an up climate. So statistically speaking, what is more likely to happen is to continue moving higher more than going lower. And if any, the type of correction we have would be of this depth before it keeps going. This is what is something pretty reasonable for us as an expectation, given what we have on the screen. Now, what if that UFO was going to be taken away? Well, yeah, then we are set for a larger move down. But a larger move down, will bring you to these UFOs, and from there, think about the size of this move down. It's similar to the size of this move down. So, and again, there are UFOs, and not only one but two. It's not like, again, going back to '07 when there was only one and it was much further down, isn't it? Based on what I have shown you before, it was so much further down. So again, market condition which is not necessarily concerning, but definitely depending on the time frame that you observe. Okay, for example, if you look at the weekly time frame, so in the weekly time frame of the S&P, so we are in a situation where 9 out of 6, 168 out of 109 means that this market is statistically exhausted and a correction is set. But again, if a correction takes place, which is likely going to last for 3 weeks, then that's going to bring you to this UFO or the other UFOs that we saw. And again, we are back in business if you define business as going long. Obviously, there are also opportunities to shorting, but given what we see on the monthly and the weekly time frame on the S&P, probably doing it using lower time frames will be more intelligent, because sooner than later this market is set, based on what we just discussed, is set to going back higher. So this is a first part of my analysis of the S&P. Of course, there is another part that I'm going to do right now, which is what are the options markets telling us, right? That's extremely relevant for us to understand, which I'm going there. Okay. Jeff, likely to correct soon. Likely already correcting. Actually, if you go to the daily time frame, even though the dots are thin and therefore the climate is not is not confirmed. Sorry about that. We are actually already showing a directional move to the downside. So we are already in correcting mode. Okay, which basically means that active traders who want to go long are probably rubbing their hands and getting ready to buy at whatever price they decide, or they started selling puts, or you name it, depending on your trading techniques, right? But the correction has already started, which in the weekly time frame we saw that it's time for this to happen, and probably may take 3 weeks to complete. Okay, based on stats, that would be a reasonable expectation. Now, changing platform and now moving to top. So we can look at SPY, which is the ETF that represents the S&P 500. We can also see that from the options point of view, okay, we see that implied volatility for the calls is above implied volatility for the puts, and therefore there are buyers in the marketplace. Okay, now we had long conversation about this in the past. Just in case some of you are new viewers of our channel, and you're not aware of what that means, well, implied volatility for the calls, okay, I'm going to call it IV for calls. Okay, so the implied volatility for the calls being above the implied volatility values for the puts. So let me write it down and then I will explain it. So this has a very important meaning, which is that for the implied volatility of the calls to be above the implied volatility of the puts, and of course I assume you know what's implied volatility. So for this to be the case, only two things can happen. Is either we got more buyers of calls than puts, okay? So if you got more buyers, I'm sorry for the typo there, missing the S after buyers, okay? But if you got more buyers of calls than puts, so if that's the case, of course, if more buyers are buying calls and less buyers are buying puts, then the price of the calls will start rising compared relative to the price of the puts. And that's what we see with the blue line being above the gray line. But now the question is, why would someone be so interested in buying calls more than puts? Well, it's because they are bullish, right? They are bullish. So that's why I'm saying that the blue line above the gray line means that there are buyers in the marketplace. Or another reason why the blue line would end up above the gray line is because you got more sellers of puts than sellers of calls. So now, why would you sell puts? If more people sell puts and less people sell calls, so the great selling on the puts will make the puts cheaper, and if the puts are cheaper, is going to bring the gray line down. So it's either the blue line is above the gray because more people are buying calls than puts, or because more people are selling puts than calls. We don't know why, but the fact is that buying calls is bullish, and my friends, selling puts is just as bullish because you negate the negative that is positive. And if you are a value investor, it's a classical technique is to sell puts at a lower price because you want the stock put to you. Why would you want the stock put to you? Because you are bullish on that market, in this case, the SPY ETF. So in other words, the blue line above the gray line, and again, for some of you, this is a long explanation because you know this well, but for some of you that may be new, it's important for me to explain it. So the blue line above the gray line means that we have buyers in the derivative markets. And do we know which price level? Well, there are many price points when we look at the option chain. So which strike is that? We don't know. But somewhere there are buyers. So that's relevant because if some there are buyers, going back to my prior chart right here. So if somewhere there are buyers, and I'm going to go back to the, let's say, monthly time frame, for example. So if somewhere there are buyers, okay, well, the probability of buyers here is already high because of the UFO. Well, now you have even more probability because here, or higher than that, or maybe lower than that, but somewhere here, you got buyers. So even if this UFO maybe was to fail, let me draw this better. Even if that UFO, was not to be that relevant, and in the end price goes through, well, maybe even somewhere in the middle where you see no UFO, guess what? They are buyers. We don't see them on the chart because they are in the options market, and they may bring the prices back up. So again, of course, if you use stops, you get stopped out, and then you're out of the trade. But if you are using options, and for example, let's say you are using spreads, and the risk of a spread is limited by the nature of the option strategy. So even though we were wrong by a certain amount here because price went below the UFO by a certain amount, your risk is limited no matter what, even if the S&P was all the way to zero, because debit option strategies or even credit option strategy, which are spreaded, have limited risk profiles, isn't it? So you would be in a situation where now you just needed to wait patiently for the price to come back up, because again, statistics suggest from the auto climate side, from the options, as we saw in multiple time frames, statistics suggest the market should go back higher. So again, I'm not pushing, and obviously everything we do here, as you can read on the disclaimer below, is for educational purposes. I may be wrong on the trade, which is why we always manage our risk, which is why I'm talking about risk management, either using stops or using limited risk strategy with options such as spreads. But definitely, the data we have in front of us is suggesting what I'm explaining with words. Okay, so this is indeed not financial advice, and you may agree, disagree, and please feel free to comment on the chat box because you may have thought of other angles. in this conversation, and feel free to enrich this conversation by adding more, even if you were to contradict what I just said, because again, the market is this. The market is made of people with different opinions. That's why some buy and some sell. But again, everything is enriching us. So if there is anything you'd like to share, go for it. Okay. In any case, this is my view based on the tools and the technology that we use and what we have on the screen. And there is one more angle that I'm gonna mention here, which is if you look at on the left here, we have the daily time frame of SPY, and all this time on the way up, we had not even one single. Actually, we can see that better on the chart on the right because it's larger. It's also a daily time frame of the SPY. All this move to the upside has been so incredibly powerful, non-stop, amazing, really, really something, that we never had at any moment in time any Elliott wave indication on the screen. Notice that the prior move that was also, something, even larger if you wish, but it was happening in a way that was what I would call healthier, because notice that at this moment in time we had an Elliott wave turning point, another one, another one, another one, another one, and another one here until we had a change of direction. Okay. What does Elliott wave turning points mean is that basically, based on the wave count and the magnitude of such waves and so on, this move to the downside was significant enough compared to the move to the upside to indicate a potential Elliott wave turning point that then happened to become a reality. Well, guess what? In this move to the upside, at no moment in time at all, there was no opportunity for any Elliott wave turning point, but today as we speak. And let me talk about today as we speak, what that means, because it may not even be a real one. But I'll talk about this in a moment. In other words, the move that we had, as we saw with the statistics of photoclimate, especially on the weekly time frame, isn't it? So it's a non-sustainable move. So we should see a correction. And typically, the type of corrections, which we also mentioned as a response to Jeff's question, right? That the correction already started. So that correction is probably going to be more significant than this little initial Elliott wave turning point that we have here on the screen. Notice if I go to the settings, edit Elliott wave, notice how the purple one happens to be the dynamic type of Elliott wave turning point, which is not like a long-term Elliott wave turning point or a medium-term or even a short-term. Notice that on this move to the upside, not as one, on this move to the upside, we got yellow and blue, okay, and then we got magenta, and then we got orange being the long-term, the blue being the medium-term. So now we don't have any of those colors. We have the purple, which is telling you that the size of the correction is very minor. It's enough to call it a dynamic potential Elliott wave turning point. And from there, guess what? It may keep going because the climate is up in certain time frames, even though statistics suggest it's not sustainable. But I would assume that on top of that, we have a red UFO there, right? So it may rally and from there it goes back down. So I would assume that we're going to have a deeper correction given the unsustainable figures that we saw, especially on the weekly time frame, where we may get to see, like a 3-week, as we mentioned before, type of correction and get to lower UFOs to have a more significant turning point. And now we're going to see Elliott wave turning points of a different color, the yellow ones, the blue ones, the orange ones, that are likely going to provide more powerful turning points. Take a look at what the purple ones do, right? So when the corrections are small, typically the reaction to those are tiny, okay? To have larger corrections, you typically need to rely on Elliott wave turning points, which are more powerful. So now, why did they say that this potential is not even confirmed? Well, because you will be able to call this an Elliott wave potential turning point the moment the day closes, okay? And we are 1 hour and a half into the trading day. We still got 5 hours to go. So, 5 hours later, you may have the S&P trading somewhere here or somewhere below, and therefore that indication is gone from the screen. So the fact that we see it now doesn't mean it's going to be there tomorrow, okay? So, and tomorrow will be the time to act, because tomorrow will be the moment where you would call this, if it's still on the screen, an Elliott wave turning point, potentially speaking. So right now, take this, carefully. because it's not, it's just a dynamic plotting that is not valid for a trade action yet until tomorrow. But anyway, it's telling you about the fact that there are buyers on board, as we saw in the options markets. That look at that, after pretty powerful moves to the downside, today is a pretty strong day, compared to the prior day. Look at the size of the body of this candle compared to the prior days, isn't it? So, with all of that, we will conclude, and we're gonna look at Walmart, Joe. So with all of that, we're gonna conclude that the equity markets, are, I would say, very likely in 2024 going to give us a pretty significant push to the upside. But probably for this to happen, we first need a significant correction. Okay, and the size of the move that we had since the year started, where we had a few days on the way down, both on the SPY as well as on the S&P futures. If I look at the daily time frame, we can see multiple days going down. Well, those moves to the downside are not significant as a correction to lead to what I would call a healthy move to the upside that would have great odds of sustainability on the way up. Okay, so in that sense, a bit of patience is required before we get aggressive. Okay, we're gonna look at Walmart, Joe. So Walmart is here. Okay. Before we look at Walmart, though, there is something else I want to do, which will actually very likely help us with this analysis further for Walmart too. And also we have a question from Mark. There was no pullback in the uptrend starting at the end of October to enter the trade to take advantage of it. Exactly. It was just like non-stop. And of course, if you are a breakout trader, so then that's it, you're in. But, the history of the markets also suggests that, if every time you got a strong move up, you did a breakout trade, many times it slapped you back on the face because then it was followed by a retracement or a correction. So we don't know the futures, so you can be very daring and just go for it right now because you have an incomplete Elliott wave turning point on the daily time frame that is not even confirmed. But you may be daring and you take the trade, and guess what? If the market keeps going crazy, you may have made 40% 3 months from now. But more often than not, and this is the statistics that Auto Climate throw at us on the screen. So more often than not, that's unsustainable, and it's much better to wait for the correction. Now, if the correction is not happening on the S&P, guess what? It's not the end of the world. There are more markets to trade, right? So one of the things we are doing today is look at multiple markets. I'm spending a lot of time on the equities because it's the one that I would say most of you are trading, and also because I'm also using this analysis to also lay out some of the concepts that are relevant to understand the markets for the ones of you that are new to our channel, so you understand and you can follow. I'll be faster with the other markets. But the fact is that, why would you look at one market only, right? So if you're using the tools that we use, it's, same effort to look at gold and looking at the S&P, right? So, if you're in a situation like what Mark just described, which is you are looking at a market you want to enter, but the market is not giving you a chance to enter because it keeps going and there is no pullback. Well, instead of just, becoming upset at that market, right? Instead, just trade another market. And because there are more, and be patient, because as we discussed many times in our live sessions in the past, sitting on your hands is indeed trading. Okay, and this is not easily understood when you're new, but definitely very important lesson when you are more experienced. So we're going to look at Walmart, but before, what about we look at the grouping? Okay, all the various sectors on the S&P. Sorry, I didn't want to change the spacing. I wanted to change the amount of days. So I'm going to load 21 days because 21 days is like a month, right? And let me make this larger. And let's look at the long term as well. And so what do we see? Okay, what do we see when we look at this? Okay, so what we see is that we have multiple sectors. So basic materials, consumer goods, consumer services, financial, healthcare, industrials, oil and gas, technology, telecommunications, and utilities. So we have multiple sectors. And if you look carefully, so for example, here we see on the long term, this sector is going up, and while it was going down recently, in the recent times, this sector is going higher. So This is healthcare, and we can analyze very well healthcare by looking at XLV, which is an ETF. Another market that could be interesting to look at is this one here, which is technology, XLK. And it's actually because of the opposite, because while it's kind of flat on the long term, on the short term, it's clearly going down. Okay, so technology seems to be going lower. And the other market, which is doing something similar, it's flat and going down, is utilities, right? So basically, we can see that some of those markets are certainly pointing down. They're probably the sectors that are going to lead for the correction. I would anticipate the correction to be 3 weeks. Okay, why? One of the reasons is because we can see how the dive on technology is quite intense, and in a way it has to be because even though I didn't show the chart, and I won't because I have other markets to analyze, but probably you are aware that the Nasdaq, which you could chart by either using QQQ, the Nasdaq ETF, or NQ1 exclamation mark on TradingView, which is Nasdaq futures. So the Nasdaq, which is basically the technology index, is the one that outperformed everything in 2023. It went up like, I think 40 plus percent during the year. So in other words, it's out of all the equity markets that are overextended to the upside, it's in a situation which is much more extreme than the S&P, which is overextended, especially on the weekly time frame, but not as much as 40% in a year, right? So in other words, XLK is showing that technology is taking a pretty big rest. So that leads me to think that may create a cascade effect where many people start selling the Nasdaq too, and again we may need to see a pretty severe correction. And severe is not a bad thing. Okay, don't take this as like a bearish or anything like that. Severe means that we may need to go down to lower UFOs. 3 weeks, as we said before, right? Everything else, it's quite flat, right? And if we were to look at where is it, consumer goods, which is food, for example. So we see a little bit of a down to the downside, consumer services as well. But you can see that the angle of the drop recently is not that bad, while in the longer time frame, it's either flat or going slightly up. So your idea about Walmart, Joe, from this point of view, doesn't seem bad to me. It may be a good candidate to explore. Now, before we explore Walmart, XLV, that was the technology sector that we saw earlier, is as you can see, sorry, not the technology, sorry about that, the healthcare sector that we saw earlier that was showing strength on the daily time frame. So you can see here the strength, and same story. We have those UFOs, but also same story. While it's a strong sector, it's entering a red UFO, and guess what? That is likely going to bring it down, again helping the whole S&P to have this correction. So XLV being stronger has not started correcting yet. You can see actually today we have an update on healthcare versus the S&P is actually down compared to yesterday. Actually, it's not. The S&P is up, but just by a little bit, whereas healthcare is up by a lot. That's what I meant to say. Sorry about that. But now, here's something interesting, okay? And because again, out of this conversation, we are concluding that equities may be a good place where to be, as long as we have a nice correction. But we also see that the S&P is making all-time high, all those things. Well, guess what? When you look at the monthly time frame of healthcare, notice that we have not made all-time high again. We have not. The S&P has, but not the healthcare. So what happens is that if the S&P does gives us a severe correction, and healthcare does correct and comes to its own UFOs and starts going back higher, sooner than the healthcare, probably the S&P will start making all-time high again. That would probably attract many buyers in the market, and when healthcare starts making all-time high, that industry is going to be very much in the news, attracting new buyers. And probably this buying price here on the healthcare may be a little bit of a hidden gem, assuming all my analysis for equity was right. It may be interesting to be exposed to XLV, maybe even more than the S&P, SPY, into the next year, assuming that we have this correction I mentioned, okay? And maybe diversification is the way to do it. And maybe, let's say you have a portfolio where, you have a percentage, you want to have a percentage in equities. Well, maybe half of that percentage goes into XLV and the other half into XPY. But notice that this is potentially the little gem that is already showing what he wants to do, but hasn't done it yet, which is break the all-time high. Okay, and if that's the case, a lot of people, that are going to be breakout traders and, people that look at, all-time high as a relevant price point may really want to get in there. Okay, and again, something relevant. In any case, for other sectors, as we saw, as consumer services or consumer goods, Walmart is in that group, and that could also be a good market. Notice how Walmart also tried to make an all-time high, came back down, and if we look at the daily time frame, to be honest, it looks pretty good as well, because we have this huge, massive open gap there, which means that if those UFOs actually do provide a reaction, we have a lot of potential movement to the upside. Okay, so that's great. Now, what I'm not a fan of is that right now, as we speak, even though we are entering a UFO, it's 8 out of 6. Okay, so that I'm not a fan of. If we look at the weekly time frame for Walmart, we are in a green UFO, and we are starting a climate. Okay, so maybe that stock is going to take off sooner than the other ones, but still, I would love to see a little bit of red on this climate on the daily time frame, and then go for it, expecting Walmart to be a stock that takes off early compared to the other stocks. Again, and this would be a very individual type of price behavior, probably given the fact that we have this open gap above. Okay. So, good one, Joe. Thanks for sharing. I think it definitely looks like a potential trade setup is available there on Walmart. I got one last thing I would like to check on Walmart, which is what about the options markets? Blue above the gray, they are buyers. Okay, they are buyers in place in Walmart. So definitely, it could be a very powerful pick for 2024. Thanks for sharing that. Last one about equities. And now we're going to move to other markets and equities. I want to check Nvidia because, we are in the age of AI. This is like in 1994 when internet started. So this is where we are at. Internet existed way before 1994, but it started being used commonly by the public and in many cases even for free in 1994, 1995, that kind of time. And we all know what happened. So this is going to be, AI is going to be way larger as a revolution. And this is going to, this is already changing businesses and lives in a major way. So obviously, when you look at companies like Nvidia, which are generating or producing products such as GPUs and TPUs, you can see the effect. Okay, and probably everybody knows, if you follow the markets, that Nvidia has been the stock of the year in a way. But a big question is what's next for Nvidia, and you can see how red is showing up. If we look at climate condition, etc. So, and we talked about XLK, the whole technology sector being down. So, I would potentially see a very, very, very large correction in Nvidia, larger than other stocks, even in technology. And it's kind of funny that we just talked about XLV with this open gap above price. We actually have an open gap below price on Nvidia, so we may need to see Nvidia go back down to 300 before we get something powerful on the way back up. Now, definitely, those price points may be extremely relevant because again, AI is just starting. Okay, so buying now, to me, it's really late to the party. But AI is just starting, and Nvidia will have many competitors as well, producing chips which are just as good or better. But definitely, it's a brand that is in the market to stay when it comes to GPUs and even more importantly TPUs, which feed everything that's happening with machine learning and AI applications. So I wanted to mention this because obviously it's been a crazily relevant stock this year, given the relevance of machine learning for the public, because in the industries it's being used for a long time, but for the public it's kind of new. Okay. Cool. Okay. Well, long conversation about equities. Hopefully, this has been fun. If you have questions or comments, you've been quiet for a while. So, again, if I may ask, just share with us on the chat box your views, or if you just want to say all good, I agree, or I disagree, or all not good, or whatever you want to say, just say it. That would be great. Okay. Yeah, well, Bitcoin mining, Mark. It's over. Mining is a practice that is not happening anymore. Only very few coins are still doing mining. Other technologies have been implemented that don't imply mining. I mean, there's still need for processing power to process, smart contracts and all sorts of things that happen in the blockchains. But mining, specifically mining, it's something that is basically no longer relevant. Okay, so that has been mining. Was the reason for prior waves on the way up in prior years. Okay, those prior waves was a lot of GPU usage for mining, but mining it's something that again is no longer relevant. Great. Okay, now gold. Jeff, this is for you, my friend. So we go for gold, and we're gonna start with gold futures. So we're gonna look at what's going on long term with gold, and as we can see, we are in a monthly time frame. Climate to the upside, 3 blue dots confirm, 3 out of 7. So again, the expectation for gold would be that gold will go up. Now, probably you are looking at this and you're thinking, wait a moment, this looks a lot like October 2007 on the X. Again, it's not relevant to just talk about one example, but at the same time, just because I mentioned it before, so yes, indeed, because we had a little bit of a tease of the all-time high, now it's going down, and what? In this case, there is nothing to stop a drop all the way to 1454, which is significant. Okay, so we could a very big surprise on the gold markets, especially if the equities market were to rally tomorrow very strongly. So gold may go down. Okay, gold may go down as a cascade effect as well because of money flow between markets. And the thing is that there is in this time frame nothing to stop it. If we look at weekly time frames, okay, there are some UFOs. Okay, but on the weekly time frame, we are now 7 out of 5, which means that we will need multiple weeks of a correction on the weekly time frame to get back to a healthy stage of gold before it goes back higher. So yeah, gold is a little bit more of a danger, in a more dangerous situation, if you wish, compared to equities. Even though if you go to daily time frames, you can see a lot of UFOs. So probably if we do have a movement to the downside on the weekly time frame on gold, it's going to be slow because it needs to go through all of these. Just like, again, sorry to go back to the S&P, but the S&P is kind of like the same. Look at how many UFOs we got on the daily time frame. So going down in one straight line, it's going to be difficult. Typically, we're going to see movements to the downside and then bounces and go back down to the downside. And this could be like that for a few weeks for gold, just like the S&P, until we get to relevant price points, okay, where the market turns. Now, again, on the S&P, we do have UFO monthly time frame. On gold, we don't. And therefore, there is more risk for a severe move to the side, okay? At the same time, why? When we look at GLD, okay, which is the gold ETF, what can we see? Well, the blue line is above the gray, okay? So we got buyers in gold. Having said that, this is less relevant compared to equities because if I look at other commodities, including commodities that have been crashing hard, like oil, look at that. The blue line is above the gray. And one of the reasons why is because in commodities are known as an instrument that crashes up. And therefore, it's a pretty normal thing that calls are above the puts because many people buy calls for hedging purposes on the commodities. Okay, companies, commercials, they buy calls because that if oil goes up, if gold goes up, it means that the price of the basic materials they use for their businesses, they go up. So buying calls will hedge that, will protect that, and therefore it's a pretty normal thing that the blue is above the gray in the case of commodities. So the fact that GLD has blue above the gray, it means that we got buyers in the market. But now, are they buying because they want to buy, and the more it drops, the more they're going to buy, or they're buying for hedging, right? So this is a question that is unanswered. There are many things in the market we cannot know for sure, but it's definitely a good thing. Okay, if you look at USO, for example, so there was a time when this let me maximize this, when USO started falling down. Notice that the whole time the blue is above the gray, okay, which is the point I just made. But notice before this very severe move to the downside, the lines went very close, like it was almost the same. So that was a very bearish sign. Okay, we are not at that stage with oil, and if we look at gold, we are not at that stage either. Okay, notice how when the lines went very very close there, from there we got something severe. Okay, yeah, sometimes we got movements that were pretty severe and the lines never went close. Okay, but again, so when the lines go close, it's almost like the gray is above the blue with the commodities. With the equities, it's not like that. Actually, equities crash down. So when the blue is above the gray, it actually means a lot. It means buyers are in the market that are willing to buy, probably even for speculation purposes, not only for hedging, for hedging shorts, but actually for speculation purposes, right? So it's a totally different story, and therefore the use of the blue line being above the gray, needs to be different, as I just explained, and hopefully this makes sense. Okay, but again, it's a good thing to have, right? Again, if the gray was to be above the blue in commodities, well, be bearish, right? Because this is something that you saw the effect, isn't it? So a little bit more risk in gold that the risk that we would have with oil. So my approach to gold would be to be careful. What does that mean? Stay out at this moment in time. Let the market to either correct or prove itself. And if this market proves itself and it starts rallying, and let's say 1 month, 2 months from now, you're gonna say, "Why? I need to wait 1 or 2 months?" Yes, because we are talking about long term. So yes, you have to wait that time. So let's say 1 month, 2 months, you have a green UFO there, then I'd be very happy. Why? Because 2 months from now, that means that the count would still be 5. 5 out of 7 still puts me where I could catch multiple months moves to the upside on gold. Where if I do it now, yeah, for sure, it may keep going. The climate is up. Okay, you may use lower time frames to enter. But if it was to really change dramatically, there is a lot of movement for this to go down by a lot, from 2,000 all the way to 1,500. That's a very significant move to the downside on gold, and these things happen. Okay, and I guess you don't want to be caught on that side of the equation. So patience is probably going to be your ally to avoid a problem. If you are in gold for a long time already, let's say you got in somewhere here and you are already in profit, maybe it's time to take some out of the table, or maybe you have a stop or some options hedge in place, and you stay in the trade fully positioned, knowing that if it goes higher, great, and if it goes lower, you're gonna exit somewhere here where your entry was there, so you will exit for a profit no matter what. But if you were to not to be positioned at the moment and you want to enter, I would see gold a little bit as a riskier play compared to equities. Again, when it comes to equities, assuming you're going to be waiting for a retracement. Okay, with gold, I'm not suggesting to wait for a retracement. I'm waiting for a green UFO to show up. Okay, which we don't have yet. Jeff, hopefully this answered your question. Let me know. More markets to analyze. Well, since I was mentioning crude oil, maybe we can look at WTI crude oil on a larger time frame. So not much happening. Of course, crude oil has been in the news, both because a few months ago it was rallying like crazy, and then since a few months back it's crashing like crazy. So it's been in the news, but if you really think about it, since like a year, not too much has happened. And it is looking like something is about to define itself, especially if it breaks down this box. So we may be headed all the way to 53, which I would say it's unlikely, because 3 out of 4 means that the normal thing to happen would be another month going down, and from there, change of climate. So again, not too concerned about it. But definitely not the ideal situation to go short, and not the ideal situation to go long either. if you think long term. Of course, if you think about other time frames like daily or weekly, of course you can get more active and you can do sky is the limit. Okay, but again, like gold, it looks like commodities need to prove themselves. Are they going to keep falling and create red UFOs? Are they going to start rallying and give us green UFOs in the larger time frames? And then we will likely know more about what's likely going to happen in 2024. Right now, it's a waiting game, so they prove themselves. With the S&P, there's nothing to prove. The market looks healthy to enter. We just need to wait for a correction just to enter at a good price point, unless you are a value investor or something like that, and you are just selling puts at a lower price. So then that's another way to do it. But I will not be selling puts on crude oil and gold because I don't know what's going to happen. We never know what's going to happen for sure, but it's pretty clear on the S&P that a specific picture has been given to us, where right now on crude oil, no UFOs on the monthly time frame are available, to either go long or short at current prices. Okay, so difficult to act, and therefore better to stay out. Okay, when it comes to USO, which is the ETF that gives us more information about oil, as I said before. So we have, blue line above the gray. The lines are not close to each other, so it seems that there are buyers in the market, which is the normal thing, and it's a good thing to have, but it doesn't mean too much because throughout all these huge drop, we saw that the lines got closed, but they never even crossed. So you have to be careful with this. Okay, you have to be careful. Notice every time the lines get close to each other, often you have a move to the in the opposite direction. Okay, but again, all of this is really to exploit short-term moves. Again, for exploiting something larger throughout 2024, we need something to show on the monthly time frame, which we don't have at the moment. Cool. Okay, so latest part of this session is going to be about currencies, and I see Mark was talking about Bitcoin. So what about we talk about the dollar, the euro, and the Bitcoin? I think that would be a great way to complete our session. So if we look at the dollar index, the dollar has been ranging between UFOs, 105 to 99, and I kind of suggested that in a session I did last year in December. And the market was here in December, and basically I expected the dollar to range for the whole year between those key price points. And actually, I was spot on this particular plan, which is obviously not always the case when we trade. That's why we use rates management. But in this case, it was exactly the case. And it's been funny, funny, maybe not the right term, but it's been interesting to see that, every time there's been a big move up or a big move down, things have happened in other markets. So like, for example, the dollar has been dropping significantly in the last months from almost 107. So actually we reached 107 all the way to, 100. Okay, that's a pretty significant drop. And next thing you know, let's say we look at Bitcoin, BTC USD, okay, in the last few months, it's been going up significantly. Has a lot to do with the fact that a lot of dollar was sold, maybe in exchange to buy Bitcoin. Okay, so a lot to do. But now you look at what happened in a daily time frame on the Bitcoin, and yesterday actually was a pretty massive move to the downside. Some currencies yesterday were dropping like as much as 10, 15%. 12%, Ethereum, some of the currencies were crashing like pretty significantly. Bitcoin was trading yesterday at 45,000, went down all the way to 41,000. So that's 4,000 points. That's 10% drop in one day. So pretty significant, okay? And that is because the dollar index was moving up significantly. So big movements in one direction, big movements in the opposite direction. Now, what's happening to the dollar? Well, the dollar is dropping a bit today. So what's happening to Bitcoin? So today the Bitcoin is bouncing pretty significantly. So you can see moving in tandem. I mean, in the end, it's all currencies, and the dollar is attached to it. So obviously, all of this is very relevant. So going back to the monthly time frame, going back to dollar index futures, the trades in the ICE exchange. So we are looking at this particular market, and we can see it's been ranging, and every time there's been a move either up or down, those moves have had significant impact in other places. Okay, and I'll leave it as a homework for you to also look at gold and oil and even the equities, and how the dollar really is a powerful asset, because most markets are priced in dollars, and when the dollar changes value, of course, it has an impact on such markets. So I'll leave that as a homework for you. Okay, but going back to the currency analysis that we're doing at the end of this session, so I would like to start with the euro. So sorry, not like this. So euro futures, so 6E1 exclamation mark, euro futures trading on the CME. So what do we see on the monthly time frame? We are in a up climate. Okay, now notice the lack of statistical values. Why? Because it's a market that was born a few years ago, but there is not enough information to get statistical data. So I'm going to use Eurospot. Okay, actually, let me be a bit more precise than that. I'm going to use Eurospot from ICE, which is an aggregated feed. This feed is basically merging and mixing feeds from most relevant brokers, as well as prime brokers, as well as banks, such as Deutsche Bank, JP Morgan, etc. So this is a very powerful feed for currencies. I mean, it's better if it's euro futures, but we don't have historical data that go as far. So, well, if we do it like that, now in the monthly time frame, you can see 2 out of 7. So, statistically speaking, the euro is set higher. So we may get to see the euro go to 116 in 2014. We may get to see that. And when looking at the daily time frame, it's loading. 1 sec. Okay, so we can see that there is no red UFO. Okay, until we get to 115, which is a bit lower than 116. So in other words, this looks like a pretty interesting one, meaning that I mean, we don't have a green UFO on the daily time frame, and now I'm thinking a bit active here, even though it's all coming from the monthly time frame. But any defined opportunity to get in, any change of climate to be blue, any depending on your trading rules and what sets an entry for you, any opportunity to buy euro may get you into a position where you may see it rally pretty fast all the way to 115, 116, because there is nothing to stop it. Even though I was looking at the monthly, even on the daily, there's nothing, right? So a pretty interesting setup that may be an interesting opportunity. Of course, to be taken with care, to be defined with risk management, the proper size, etc., etc. Okay, going back to the dollar index. So the dollar index, for the euro to rally so much, the dollar index would probably end up falling. Okay, well, there is room for the dollar to fall from 102 to 99, right? Now, this is a dollar index, meaning that this is against a basket of currencies. So you may feel that there is less room to go. Okay, you may feel that there is less room to go. But because it's traded against a basket of currencies, okay, and also because this UFO is light green instead of dark green, so we may actually see the dollar to come all the way maybe in the middle of this UFO, the inner circle, before it bounces. And this drop is sufficient to bring the euro to 115, 116. And by the way, the dollar is already in a down climate. So, there is an opportunity, at least technically speaking, and depending on your trading plan and your rules, this may make sense to you or not. And finally speaking, if the euro goes up, also, with the ally dollar going down, guess what? Let's talk about Bitcoin, which is a market that we need to talk about because we need to, because it's becoming more and more relevant. And what I'm saying, why am I saying that? Because you probably know that in 2024, it does look like regulators in the US, they will approve the existence of ETFs that derive their value from spot Bitcoin. Not Bitcoin futures, but spot Bitcoin, which is very significant and very relevant from a news point of view, from a regulation point of view. And this is likely going to attract many new buyers of Bitcoin that may buy Bitcoin spot, because now, since regulators are relying on Bitcoin spot to produce ETFs, or allow the production of ETFs, I should say, So now more people may believe on Bitcoin, and more people that may not believe on Bitcoin, they may now want to actually use ETFs because there is regulation behind them. So all in all, may mean more buyers for Bitcoin, and if Bitcoin goes up, it means people need to sell dollar to buy the Bitcoin, and that may push the dollar index lower, which may help the euro to go higher. So you can see the cascade effect there. So again, just like I said earlier, with an opportunity to mix SPY with XLV, right, and get, let's say you want to have a portfolio with equities, and you devote, X percentage of your capital to ETFs, equity ETFs, and I just suggested maybe your plan will be to have 50% in SPY and 50% on XLV because of that better technical chart that we saw on XLV, and what we can see started happening already in XLV, which started going higher before the other ones. Well, here the same applies. The same rationale applies. Maybe if you want to be invested in currencies, well, the bet, at least for the beginning of the year, would be to be against the US dollar, and maybe one way to be against the US dollar would be to use half of your allocation for currencies, 50% of it on euro long, and the other 50% on Bitcoin long, either Bitcoin spot or Bitcoin ETF or Bitcoin futures. You could be trading BTC on CME, for example, which is a Bitcoin futures contract. And now you're trading Bitcoin in a regulated environment. An ETF could also be traded in an exchange, okay? But you would have no leverage, okay? Even though BTC contract is very large, so I guess it would only work well if your account is also very large. But again, there are products out there, and there are choices that could be helpful to you. So hopefully interesting for you to see what's happening in the world of currencies. I kind of feel, given the names I see connected with us today, that most of you are probably more into equities and maybe metals or certain commodities, and maybe a bit less into currencies. But maybe this opens your eyes to at least you going ahead and doing a little bit of homework and research in those markets, because again, it's fun to do research, and also it's a unique situation for Bitcoin that regulators will approve those Bitcoin ETFs out of Bitcoin spot. The keyword is spot, okay? Because there are ETFs out there that are made of Bitcoin futures. So that's an interesting one. Anyway, we just reached the time to conclude our session. Before we do so, and while you type on the chat box, if you have any final question, I would like to say thank you for joining me in this first session of the year. We don't often go do these type of market reviews. This was a homework session together, if you wish. This is definitely not financial advice. Please, if you're gonna try to exploit any of the scenarios I explained, just make sure you have a trading plan around it and you manage your risk. Okay, this is for educational purposes. Let's be serious, everybody. But definitely, I'm excited that we went through this conversation, because again, we don't do this often. And we did it today, so it was fun for me. Hopefully it was enriching for you. I thank you very much for joining me. I also wish you happy new year. It's a special day today at the beginning of the year to do this session, and again, I'm just looking at the chat box in case any question kicks in, and if not, we will call it the day. John, thank you so much, my friend, for that. Thank you so much. Just waiting a few more seconds, maybe a couple of minutes, in case a chat comes in. So I make sure that I do not disconnect and then there was an unanswered question. That would be a shame. So I'll wait a little more. But if you have no questions, please type no questions or all good, something like that, so I know. And then no one needs to wait, and we can just leave it like that and say bye. Thank you, Mark. Thank you, Joe. This is great. So I guess that, time to say bye. Happy New Year. I was going to say Merry Christmas. That's too late. Happy New Year. Again, super pleasure. Let's have a great year in front of us. Trade safe, trade well. Remember, sitting on your hands is also trading. Definitely discipline. It's the key. Discipline combined with risk management is what will keep you alive. And if you're not alive, your account cannot grow. So everybody, if you are new to trading, or if you never understood the importance of discipline, let's make 2024 to be the year where you understand the importance of risk management and discipline, and everything else is about building your trading plan, building your trading psychology strength, building your routines, your muscle memory, and if we can help in any of that and more with whatever is it that you want to do in the marketplace, happy to help. So, we have a beautiful section on the website for questions and answers. Feel free to type your questions. We'll give you answers. If you want to email me directly, of course, happy to receive your emails. And from time to time, we are live in the channel. By the way, we have a beautiful futures course live happening in the middle of January. You can see that in our calendar on the website. If you are interested in learning futures and you have never traded futures before, so take a look at the calendar, take a look at the website, register for the course, and we'll see you then. Mark, what are we doing with ChatGPT? Well, there is a Jose Blasco ChatGPT out there. There is a Jose Blasco GPT, which basically is a GPT that we have trained with a lot of our materials, with everything I said in close to 1,500 videos on our YouTube channel. So everything I said is data that we use to train that GPT, everything that is part of our courses, everything that is part of our user guides. So in other words, the Jose Blasco GPT is supposed to be a copy of me, where if you ask trading questions, is supposed to answer, with the same information I would answer myself. So from a knowledge point of view, it's same as me. Of course, from an interaction point of view, of course, it's a GPT. So you chat with it, and sometimes, depending on your prompts, it may give you information which is not relevant. But Jose Blasco GPT is not perfect, but sometimes what's not perfect is what you type. So just make sure that when you ask questions with details, so you can get answers that you want. Okay. Jose Blasco GPT is an OpenAI GPT, and because it's not the Chat GPT from OpenAI, then it requires a ChatGPT Plus membership, which if you have, then you can use. If you don't have, then you cannot use Jose Blasco GPT, because again, it belongs to the OpenAI ecosystem, and that's how it works. But yeah, feel free to use it, and I think it's fun, and you can upload files. You can upload a spreadsheet with market data. You can upload a picture with a chart and tell, hey, what do you see, Jose Blasco GPT? And you can upload stuff, you can ask questions, you can do all sorts of things. So have fun with it, and just tell me the good and the bad, okay? Because I'm sure that there's room for improvement, but at the same time, it's good stuff as well. So whatever serves you, if it makes you happy, let me know. It'll make me happy. Whatever is improvable, let me know as well. I'm happy to keep training the Jose Blasco GPT so it becomes better and better. My friends, super pleasure. I love these sessions. Thank you for joining me, guys. You guys are the best. Keep up the good work as always, and see you around. Bye-bye. See you soon.